The most dangerous words in financial history are not shouted in panic, they are whispered in confidence. This time is different. They are spoken in boardrooms flooded with sunlight, in television studios filled with certainty, and in trading floors buzzing with optimism. They sound reasonable, logical, even intelligent, and yet, those 4 words have stood at the edge of every great collapse humanity has ever experienced. In the years before a crisis, fear slowly disappears. It doesn't vanish all at once. It fades quietly, replaced by innovation, new theories, and clever explanations for why old rules no longer apply. Markets evolve, technology advances, policies improve. People convince themselves that the past was clumsy and primitive, while the present is refined and smarter. History, they say, has been upgraded. In the late 1920s, America believed it had entered a permanent age of prosperity. Factories were efficient, consumer credit was expanding, and the stock market seemed unstoppable. Newspapers called it a new era. Economists argued that modern financial tools had eliminated the boom and bust cycle. Stocks didn't crash anymore, they adjusted. Until October 1929 proved how fragile that belief truly was. Decades later, the same confidence returned, wearing a different costume. In the late 1990s, the internet promised a revolutionary economy. Traditional valuation didn't matter, people said, because clicks were the new currency. Companies with no profits soared to unimaginable heights. Skeptics were mocked for being old-fashioned, and when the dot-com bubble burst, trillions vanished almost overnight. Then came the mid-2000s. This time, the faith was in housing. Home prices had never fallen nationwide before. Sophisticated models spread risk so cleverly, bankers claimed, that the system was safer than ever. Mortgage-backed securities were sold as nearly risk-free. Regulators relaxed. Investors trusted the math. In 2008, that confidence collapsed into the worst financial crisis since the Great Depression. Each era believed it had learned from the last. Each era was wrong. The illusion of this time is different isn't about ignorance, it's about human nature. Progress blinds us. When systems grow complex, people assume complexity equals control. When profits rise steadily, risk feels distant, theoretical, almost imaginary. The longer stability lasts, the more unnatural collapse begins to feel. Psychologically, humans are wired to project the present forward. If things have been good for years, we assume they will remain good. If prices rise consistently, we mentally rewrite the past as confirmation of safety. Warning signs don't disappear, but they get reinterpreted. Debt isn't dangerous anymore, it's leverage. Speculation isn't reckless, it's innovation. Concentration of wealth isn't fragile, it's efficient. Every bubble creates its own language to justify itself. And those justifications are powerful because they're built on partial truths. Yes, technology does improve productivity. Yes, financial tools can distribute risk. Yes, globalization increases efficiency. But history doesn't punish progress. It punishes excess confidence. The deeper truth is uncomfortable. Crises don't happen because people fail to understand the system. They happen because people understand it too well, or at least believe they do. Models replace humility. Forecasts replace caution. Confidence replaces skepticism. In every era, there are voices warning that something is wrong. They point to rising leverage, asset prices detached from reality, incentives pushing risk into the shadows. But during booms, warnings sound like negativity. No one wants to hear that the party might end, especially when everyone is still dancing. So those voices are ignored, sidelined, or dismissed as pessimists who don't get it. History shows that the most dangerous moment in any financial system is not when fear dominates, but when fear disappears entirely. When people stop asking what could go wrong, that's when risk quietly multiplies. Stability itself becomes the threat. This illusion is reinforced by institutions. Governments want growth. Corporations want expansion. Investors want returns. Media wants optimism. The system rewards belief, not doubt. Questioning the narrative feels almost irresponsible when everyone else is profiting. And so the story repeats. People didn't think collapse was impossible. They simply didn't think about it at all. The cruel irony is that crises don't arrive as strangers. They arrive wearing familiar faces. Excess debt, asset bubbles, easy money, speculation fueled by narratives of progress. These patterns don't change. Only the technology and terminology do. History doesn't predict the future by copying events exactly. It predicts the future by repeating behavior. Markets are not moved by charts or equations. They are moved by fear and greed, hope and denial, confidence and panic, and those forces never evolve. Every time society believes it has finally outsmarted history, history patiently waits. Because the illusion of this time is different is not a mistake of intelligence. It is a mistake of memory. And as long as humans forget how fragile confidence truly is, the cycle will continue. If confidence is the spark, then human behavior is the fuel. Long before algorithms, before central banks, before stock exchanges lit up digital screens, financial crises followed the same emotional rhythm. The names changed, the tools evolved. But beneath the surface, the driving forces remained untouched. Panic and greed, fear and euphoria. The ancient instincts that once determined survival now quietly shape markets worth trillions. The story begins centuries ago, in places that feel distant and irrelevant, and yet are uncomfortably familiar. In 17th century Holland, tulips became objects of obsession, not because they were useful, but because they were rare, beautiful, and socially symbolic. Prices began to rise, slowly at first, then faster. Soon, people were trading futures contracts on flowers still buried in the ground. Ordinary citizens borrowed money to speculate. Taverns became trading floors. Skeptics were dismissed as unimaginative. And when prices collapsed, they collapsed completely, leaving behind ruin and disbelief. It's tempting to laugh at tulip mania. Flowers, after all, seem harmless. But the pattern it revealed has never disappeared. Greed does not announce itself loudly. It sneaks in quietly, disguised as opportunity. It begins with reasonable optimism, supported by early success. As prices rise, participation grows. More people join, not because they understand the asset, but because they see others getting rich. Social proof replaces analysis. The crowd becomes the compass. This is where behavior begins to matter more than fundamentals. As momentum builds, risk feels lower, not higher. Rising prices create the illusion of safety. People stop asking whether something is worth the price and start asking how much higher it can go. That single shift marks the emotional turning point of every bubble in history. The South Sea bubble in the 18th century followed the same script. So did railway manias in the 19th century. So did the roaring stock market of the 1920s. In each case, new technology or opportunity provided a compelling story. Railways would connect nations. Stocks represented modern capitalism. Prosperity felt inevitable. Stories are powerful because humans don't invest in numbers. They invest in narratives. A good story can overpower logic, especially when it promises transformation. It reframes risk as vision. Doubt becomes ignorance. And the more people repeat the story, the truer it feels. Markets don't just reflect reality, they amplify belief. Then comes leverage. Leverage is the accelerant that turns optimism into fragility. Borrowing allows more participation, larger bets, faster gains. During booms, leverage feels invisible. As long as prices rise, debt looks harmless. Even smart investors convince themselves that leverage is manageable because it worked yesterday. History shows that leverage never kills a system during the rise. It kills it during the pause. The moment prices stop climbing, the emotional tone shifts, confidence wobbles, small doubts emerge. A few investors try to exit quietly, but leverage demands constant motion. Loans must be repaid, margins must be maintained, and when prices dip, forced selling begins. This is where greed flips into panic. Panic spreads faster than optimism because fear demands immediate action. Investors who ignored risk for years suddenly focus on nothing else. Everyone wants liquidity at the same time. Assets once considered safe become untouchable. Prices don't fall because value disappears, they fall because trust does. The crash feels sudden, but it isn't. It is the release of pressure built over years. What makes these cycles so persistent is that humans consistently underestimate their own predictability. We believe ourselves to be rational, forward-thinking, and informed. Yet in moments of uncertainty, we follow the crowd just as instinctively as our ancestors did. Even professionals are not immune. Highly trained economists, fund managers, and policymakers fall into the same behavioral traps. Groupthink replaces independent judgment. Career risk outweighs actual risk. It feels safer to be wrong with everyone else than right alone. Warnings are ignored not because they lack evidence, but because they threaten consensus. And consensus feels comforting. Another repeating pattern is moral hazard. When people believe losses will be absorbed by someone else, governments, banks, institutions, risk-taking increases. Safety nets, while stabilizing in crises, quietly encourage excess during booms. History shows this tension repeatedly. Protection breeds confidence. Confidence breeds risk. Risk breeds collapse. The market becomes a mirror, reflecting not intelligence, but emotion. What's remarkable is how clearly these patterns are documented. Every major crisis has been dissected, analyzed, and explained. Books are written, lessons are declared, regulations are passed, and for a while behavior changes, but memories fade. As time passes, a new generation enters the system. They did not feel the pain of the last collapse. They know it only as a chapter in a textbook, not as a lived experience. Without emotional memory, caution feels unnecessary. Risk feels abstract. This is how history resets itself. The same behaviors return, justified by new technology, new data, new theories, but the emotional core remains untouched. Greed still whispers. Panic still screams, and the crowd still moves together. History doesn't repeat because people forget facts. It repeats because they forget feelings. Until fear returns, fully and violently, reminding everyone that markets are not machines, they are human systems, fragile and emotional, built on belief. Crises rarely begin with explosions. They begin with silence, a small imbalance, a minor default, a market no one is watching too closely. At first, it barely registers. Analysts call it contained. Officials describe it as manageable. Investors shrug and move on. History shows that the most devastating collapses do not start where attention is focused. They start at the edges, in places dismissed as insignificant. In 2007, the global financial system didn't crack because of Wall Street titans or central banks. It cracked because of subprime mortgages in quiet American neighborhoods, loans given to people who could barely afford them, products considered too small, too fragmented, too boring to matter. And yet, those loans were woven deeply into the global financial fabric, disguised, repackaged, and multiplied until no one could see where the risk truly lived. That is how small shocks become global catastrophes. Modern financial systems are tightly interconnected. Efficiency demands connection. Growth depends on it. Capital flows freely across borders, institutions, and markets. This creates speed, scale, and opportunity, but it also creates fragility. When one link breaks, the stress doesn't stay local, it travels. The danger isn't the shock itself, it's the reaction chain. A single failure forces reassessment. Reassessment triggers doubt. Doubt spreads through institutions that rely on trust. Banks stop lending, investors pull back, liquidity evaporates. What was once a contained problem becomes systemic because everyone is suddenly asking the same question: who's next? This is where complexity becomes a liability. Highly complex systems feel stable because they operate smoothly in normal conditions, but complexity hides risk. It obscures cause and effect. It allows vulnerabilities to accumulate unnoticed. When pressure arrives, no one fully understands how the system will respond. During calm periods, complexity is celebrated as sophistication. During crises, it becomes confusion. In 1998, a single hedge fund, long-term capital management, nearly collapsed the global financial system. It wasn't large by today's standards. It didn't operate retail banks, but it was deeply connected. When its highly leveraged bets began to fail, the shock rippled across markets. The Federal Reserve intervened not because the fund mattered, but because its connections did. That lesson was noted, and then largely forgotten. Financial systems grow denser over time. Institutions hedge with each other. Risks are transferred, sliced, and redistributed. On paper, this looks safe. In reality, it concentrates uncertainty. When stress appears, no one knows who holds what. Transparency disappears exactly when it's needed most. Fear thrives in uncertainty. As small cracks widen, narratives shift. Optimism becomes caution. Caution becomes suspicion. The language changes first. Analysts start using words like headwinds and temporary dislocations. Then comes stress and volatility. By the time the word crisis appears, the damage is already done. Markets are forward-looking, but humans are reactive. The tipping point often comes when institutions stop trusting each other. Trust is invisible in good times and priceless in bad ones. Banks lend not because they have excess money, but because they believe they will be repaid. When that belief weakens, lending freezes. Without credit, economies slow. Without liquidity, markets seize. This is the moment when policymakers step in. History shows that crises force decisions that would have seemed unthinkable months earlier. Emergency lending, bailouts, guarantees. Central banks expand balance sheets at extraordinary speed. Governments intervene, not out of ideology but necessity. The system demands stability at any cost. These interventions can stop collapse, but they cannot erase consequences. The real damage of crises isn't only financial, it's psychological. Trust, once broken, does not return quickly. Investors become cautious. Businesses delay expansion. Consumers cut spending. Growth slows not because resources vanished, but because confidence did. This is why recoveries take longer than booms. What makes small shocks so dangerous is timing. They strike systems already stretched by leverage, optimism, and complacency. They expose weaknesses that were always there. The shock doesn't create the problem, it reveals it. In hindsight, crises appear obvious. Warning signs line up neatly. But foresight is clouded by incentives. During booms, no one wants to be the first to pull back. Selling early feels foolish when prices keep rising. Regulators hesitate to intervene for fear of slowing growth. Politicians fear unpopular decisions. Delay becomes the default response. By the time action feels justified, options are limited. History teaches that global catastrophes are not the result of single failures, but of systems pushed beyond their limits by confidence. Small shocks matter because they test resilience. And when resilience is low, even minor stress can bring everything down. This is the paradox of modern finance. The stronger it appears, the more fragile it may be. Because strength built on trust collapses the moment trust disappears. Every crisis leaves behind clues. They don't hide in secret documents or encrypted data. They sit openly in balance sheets, market behavior, and public statements, waiting to be noticed. And yet, history shows that these warnings are almost always ignored, not because they're invisible, but because they're inconvenient. Long before markets collapse, signals begin to flash. Debt rises faster than income. Asset prices detach from underlying value. Risk concentrates in places few bother to examine. These aren't surprises, they are patterns. and they appear with remarkable consistency across centuries and continents. Before the Great Depression, stock prices soared far beyond corporate earnings. Margin debt exploded as investors borrowed heavily to chase gains. Newspapers celebrated a permanent boom. The warning signs were discussed quietly while the public narrative remained loudly optimistic. Before the 2008 crisis, housing prices rose faster than wages for years. Mortgage standards deteriorated. Financial institutions grew increasingly leveraged. Complex securities spread risk so widely that no one could trace it. Regulators issued reports. Economists raised concerns. The system moved forward anyway. Why? Because warnings are costly to act on. Pulling back during a boom means sacrificing short-term gains. It means looking wrong while others profit. It means facing pressure from investors, competitors, and political leaders who benefit from continued expansion. In financial systems, incentives favor continuation, not caution. Those who warn early rarely get rewarded, they get ignored. Another reason warnings fail is narrative control. During booms, success stories dominate attention. Media highlights growth, innovation, and wealth creation. Dissenting voices are framed as pessimistic or outdated. Over time, the dominant story becomes self-reinforcing. Evidence is filtered to support belief. Human psychology prefers reassurance over disruption. Even regulators fall into this trap. Institutions designed to prevent crises are staffed by humans subject to the same biases. They rely on models built from recent data, not distant history. They respond to political pressure. They hesitate to intervene unless danger is undeniable. By the time danger is undeniable, it is unstoppable. There is also the problem of false alarms. Not every warning leads to disaster. Markets can remain irrational longer than expected. Asset prices can stay elevated for years. This trains people to ignore signals that don't produce immediate consequences. Caution feels unnecessary. Skepticism feels unprofitable. History shows that the final warning is usually ignored because it looks like all the others that came before it. Another recurring red flag is concentration. When risk accumulates in a small number of institutions, assets, or strategies, fragility increases. The system appears efficient, but resilience disappears. Diversity of behavior is replaced by uniformity. Everyone holds similar positions, responds to similar signals, and exits at the same time. Uniformity creates speed. Speed creates chaos. Liquidity, too, is often misunderstood. During booms, liquidity feels abundant. Markets trade easily. Prices move smoothly. But liquidity is not a constant. It is a mood. It exists because participants believe they can exit when they want. When that belief fades, liquidity vanishes instantly. Crises expose the illusion of liquidity. History also warns about over-reliance on past stability. Long periods without disruption breed confidence that systems are safe. Risk models treat recent calm as evidence of resilience. But stability often signals suppressed volatility, not eliminated risk. .com can be deceptive. Perhaps the most tragic warning sign is complacency itself. When discussions of risk disappear entirely, when caution feels unnecessary, when skepticism is mocked, that is often the final stage. Silence replaces debate. Confidence becomes absolute. That is when systems are most vulnerable. After each crisis, leaders vow to remember. New rules are written, safeguards are introduced. The language of never again fills speeches and reports, and for a time vigilance increases. Then memory fades. As years pass without catastrophe, warnings feel theoretical, risk feels distant. The next generation assumes protections are permanent, and slowly, the conditions that produced the last crisis begin to reassemble under new names. History doesn't repeat because warnings fail. It repeats because warnings succeed too late. The lesson is not that crises are unpredictable. It is that they are politically, socially, and psychologically inconvenient to prevent. The signs are always there. The challenge has never been seeing them, only believing them in time. The next crisis will not announce itself. It will not arrive with unfamiliar tools or unprecedented forces. It will not look like a stranger. History tells us something far more unsettling. The future collapse is already forming, shaped by the same behaviors, the same incentives, and the same blind spots that have defined every crisis before it. What will feel new is only the surface. In the years before each major breakdown, society becomes obsessed with identifying what makes the present unique. New technologies, new financial instruments, new economic theories. These differences become shields against historical comparison. People argue that the past cannot apply because the world has changed too much. But history does not operate on technology. It operates on behavior. Every era produces its own version of excess. In one generation, it was land. In another, it was railroads, then stocks, then housing. The asset changes, but the emotional arc remains identical. Optimism grows into certainty. Certainty hardens into denial. Denial collapses into panic. The next crisis will follow this arc. It may begin in places that currently feel safe, or in corners dismissed as irrelevant. It may involve instruments celebrated as innovations or markets praised for efficiency. It may be triggered by an event that seems trivial in isolation. The spark is never the story. What matters is the environment it lands in. A world shaped by leverage, confidence, and interconnectedness. A system optimized for speed and growth rather than resilience. A culture trained to react instead of reflect. History suggests that the most dangerous moments come after long periods of stability, when growth feels normal, when volatility feels obsolete, when caution feels unnecessary. That is when risk accumulates quietly, unnoticed, and unchallenged. The illusion of control is strongest just before it shatters. What separates those who survive crises from those who are consumed by them is not prediction, it is humility. The recognition that systems can fail, that incentives distort judgment, that narratives can lie. History rewards those who question certainty, not those who chase it. But humility is hard to maintain in a world built on competition and return. Markets reward confidence. Media rewards clarity. Politics rewards optimism. Doubt feels uncomfortable, even irresponsible. And so, once again, history's lessons are acknowledged and then set aside. The future will not be saved by better models or faster data. Crises have never been caused by lack of information. They have been caused by the refusal to act on what is already known. Numbers do not fail, judgment does. The past does not offer a script for exactly what will happen next. It offers something more valuable, a warning about how humans behave when they believe they're safe. That belief is the real risk. If history predicts anything with consistency, it is this. The next collapse will feel obvious only after it happens. The warning signs will be painfully clear in hindsight, and people will ask the same question they always do. How did we not see this coming? The answer will be the same as it has always been. We did, we just didn't want to believe it.